Greetings to the gods. Peace, love, family, health, strength. Welcome back to my channel. Today we're continuing America's Hope and Trinidad and Tobago's Hope. Volume 1, Chapter 16, The Signature. The bank's attorney offered evidence that the borrower signed the promissory note and received a check. The borrower claimed that the document was a forgery. As judge and jury, you must determine who is telling the truth. If you sign a $200 check and mail it to Tim, and he alters the check by changing the $200 to $20,000, is your signature on the check a bona fide signature? The definition of bona fide means an act done in good faith, without fraud or deception. An act done without notice of fraud. Signature means a mark or written name to authenticate a writing or document. One places a signature on a document to authenticate the validity to the document. Forgery means to alter a document with intent to defraud. Forgery makes the signature null and void. The question is, did your signature validate a $200 or $20,000 check? The altering of the document makes the document a forgery, and your signature no longer attests to the validity of the forged document. The forged document may have your handwriting or name at the bottom, but your signature is not lending validity to the authenticity of the document because it was altered. The Rocky Mountain News, Sunday, February 9th, 1997, printed an article entitled, "Officer Charged with Forgery," in which a Denver patrolman who lost his driver's license in a drunken driving case was charged with using a phony license. The patrolman pleaded guilty. A forgery does not only mean the signature was forged, it may also mean the document was altered. The bank knew that they would not loan 1 cent of other depositors' money or legal tender to obtain the promissory note. They knew they would record it as a loan from you to the bank and enter the bank bookkeeping entry as if they deposited it. They stamped the back of the note to validate it or to have the note act as money to fund the check. That stamp and deposit exchange fundamentally altered the document, along with the cost and risk of the loan, and did the opposite of what the borrower's signature had endorsed. The stamp allowed the promissory note to fund the check instead of other depositors' money. The question is, was the promissory note with the borrower's signature validating a document which agreed only to repayment of the loan by the borrower, or did the borrower agree to loan himself his own money and then repay the bank as if the bank had loaned him other depositors' money? Only the borrower can testify because the bank does not sign the agreement. A notary can claim you signed something, but how can they claim the document was not forged? To do that, they must determine whether the promissory note is or is not money. If you agreed that it was not money, the document would need to have been forged after you signed it. The bank exchanged the promissory note for credit in the borrower's transaction account. When the check was withdrawn, was that check a forgery? How can they deposit and withdraw without your knowledge or without your signature to open up the account or as approval for the check? As judge and jury, you decide whether there was a forgery involved or not. Chapter 17. Who loaned exactly what to whom? To save repeating, simply combine earlier quotes from the Federal Reserve Bank and the bank bookkeeping entries to prove that the promissory note was recorded as a loan from the alleged borrower to the bank. The loan to the bank was proven by the promissory notes recorded as a bank asset matched with a new bank liability. The loan to the bank funded the bank loan back to the same alleged borrower. The funds being returned back to the same alleged borrower is proven by the check transferring the newly created liability to another checking account. Two loans were exchanged. The Federal Reserve Bank's policies and procedures, the bank balance sheet, the bank bookkeeping entries, and the bookkeeping entries in modern money mechanics prove it. Bankers call it a loan. The money trail shows a deposit or exchange. The truth is that the borrower's promissory note funded the bank loan check. The new bank liability is the proof that either there was a loan to the bank, the promissory note was stolen, or the bank received it for free. Some people question me asking how I know for sure that the bank bookkeeping entries recorded it as a loan to the bank. The proof is in the accounting principles and the policies and procedures mandating standard bookkeeping entries for banks. Bank auditors confirmed the bookkeeping entries are standard for all banks. There may be a short or long version, but the net result is the same. My next book, Volume 2, and the cassette tapes go into more detail. Please watch out for one bank trick. They may claim that you can cash the bank loan check and receive cash, resulting in no new bank liability. If you receive cash, there is no new liability. When the seller of the house you are purchasing deposits the cash, the new liability results. Anytime the promissory note is recorded as a bank asset and the promissory note is used to fund the bank loan check, a new bank liability will appear. The newly created bank liability means the bank received the promissory note for free. The banker cannot answer one tax question. If he does, he could go to jail. How did he get the promissory note for free? If a person or business received $100,000 for free, the IRS is right there demanding taxes. It could not be a gift because the borrower had to have known there was not a loan of actual cash value to the alleged borrower as consideration loan to obtain it. If there is no loan, there is no need to repay it. If it was a loan to the bank, not taxable to the bank, every American would demand the loan be returned, canceling every bank loan. If the loan to the bank was forgiven, it is taxable to the bank. If it was stolen, it is taxable to the bank. The bank tax return signed under penalty of perjury will tell us if it was a loan to the bank or if they obtained it for free. To avoid a tax question, the banker must then claim that the bank checking account balance is money. If it is money, the bank could never be obligated to allow you to write checks off the checking account balance, nor obligated to give you cash for the money in your checking account. Legal tender is recorded as a bank asset, and owing legal tender is a bank liability. If a bank liability is money per the bank or judge, then that money is the opposite of legal tender. The bank liability and the promissory note both owe legal tender, which is the opposite of legal tender. If money is deposited at the bank, there is a new bank asset and liability. The new liability and the new asset represent the same deposit. If the bank claims the bank liability is money, then the matching asset, cash, check, promissory note deposited is equally money. The new liability represents the matching asset, and the new asset deposited represents the matching new liability. For a banker to win, he must prove legal tender asset deposited ceases to be money, or legal tender and the new matching bank liability is money. The banker must prove that one can issue a check without first depositing cash or something having actual cash value asset to fund the check liability, thus proving check knitting is now legal. The bank must prove that they are no longer obligated to exchange checks liability into cash assets. The bank must prove that they no longer owe us the money in our account. The liability is merely a token representing the real money asset. Did you hear about the robber who got caught? He claimed he was just borrowing the money. Unauthorized borrowing is a theft. An unpaid loan is really a theft. If you do not repay your alleged loan, the bank takes you to court. Perhaps you should do the same to the bank. As judge and jury, you should ask the banker a few questions. If a depositor deposits a 50 gold coin and the banker gives the depositor a 50 gold coin receipt, allowing the depositor to exchange the receipt for the return of the gold coin, in your opinion, is the gold coin bank asset, money, or is the gold receipt bank liability, money? Obviously, everyone including the banker knows the gold coin is the money. If I deposit 100 cash in the bank and the bank gives me a 100 bank deposit receipt, crediting my account with 100, is the receipt money or is the cash the money? Obviously, owing money is not money. Cash is the money. This just proves the bank liability is not really money. It proves that the bank asset cash is the real money having the real value. If you deposit the cash at the bank, you really exchange the cash, bank asset, for an equal amount of checkbook money, bank liability, which you can spend by check. If you are forced to earn cash and give the cash to the lender for free, and if the lender deposits the cash, exchanging it for checkbook money and returning the checkbook money back to you as a loan, you will need both husband and wife working to put bread on the table. If you follow Lincoln's banking system and quit giving your payroll check away to the banker, your wife could stop working and you could maintain the same standard of living. If you both work, you could double your wealth. If you are continually stolen from, you will have to work more to put bread on the table. Stop the stealing and counterfeiting and you will have more wealth. For the banks to receive your wealth for free, they must call the bank liabilities money. They even have you calling it checkbook money. 18. Chapter 18. Money versus credit. Did the bank loan agreement say they would loan you credit? As an expert witness, I want to use the bank's definition of money and credit. Federal Reserve Bank publication Your Money states, money is a medium of exchange. Our money states, credit is the postponement of the payment of money. Court cases confirm the same definitions. By using the Federal Reserve Bank definitions, policies and procedures, you can nail the coffin shut on their argument. They cannot say they do not know or follow the Federal Reserve Bank policies and procedures. Interest is defined as a charge for the use of borrowed money. It does not say for the use of the postponement of the payment of money. Is the bank now going to redefine the words money, interest, and credit? Black's Law Dictionary claims that the Federal Reserve Board explains a check is payable in a certain sum of money. Federal Reserve notes are recorded as a bank asset. A bank liability is a bank scorecard showing how much legal tender the bank owes depositors. So the liability is not a certain sum of money. The bank check cannot, by the bank's own definitions, pay credit, a postponement of the payment of money. Did the bank loan you credit? A loan is defined as an agreement to have money transferred from one person to another, which must be returned with or without a charge for the use of money. That is, a loan is temporary use of an item which itself, or its equivalent in kind, must be returned with or without a fee for the use of the item. Money is not credit. The bank policy is to use the same bank bookkeeping entries as if the bank recorded the promissory note as a loan from you to the bank. It is an implied loan because the bank recorded it as a loan from you to the bank, and the new liability is the proof. If you have equal protection under the law, money, credit, and agreement, you have the right to do one of two things: demand your promissory note back plus all past payments so that you get its equivalent in kind back, or repay the bank loan in credit. Give them some of your postponement of the payment of money. They created it, so why can't you do the same? They will try and deny you equal protection under the law, money, credit, and agreements. This is the CPA bank auditor's nightmare. They had intent. It is their definitions, their agreement which they wrote, their bank bookkeeping entries, and their advertisement claiming they made a loan. Do we have deceptive or unfair trade practices showing confusion and misunderstanding? Remember, no rights can be acquired by fraud. Can you imagine the bank foreclosing on someone as the alleged borrower is notifying the court, bank, the banker's attorney, and sheriff of a bank fraud? Imagine the victim being foreclosed on, then suing the bank and the banker's attorney for conspiracy to defraud and bringing fraud on the court. The attorney will be placed on the witness stand, and the former victim will ask him all the right questions. If he commits perjury, he automatically loses his bar membership. He is no longer an attorney. Many attorneys have malpractice insurance. Are you starting to see why judges do not wish to hear any of these arguments in their court? I was in one court case where we demanded that the judge make a decision whether a promissory note is or is not money. The judge flew off the bench with his robe flying behind him. The bank attorney followed him back to the judge's chambers. They made it clear they would not discuss the issue. When another banker was asked a similar question, the judge broke his pencil and ordered no more questions of this nature be asked. If it is money, you give the lender some more of the same kind of money. If it is not money, the bank committed checknitting and gave you illegal consideration. Imagine how a judge would react if we discussed the credit issue. If there is an agreement, the lender must give you the details of the agreement. Chapter 19. What is a bank liability? The Dictionary of Banking Terms defines a liability as, quote, a legally enforceable claim on the assets of a company, end quote. It explains that the funds the bank owes are bank liabilities. Black's Law Dictionary defines a liability as a, quote, duty to pay money, all character of debts, end quote. It defines a debt as, quote, a sum of money due by certain and express agreement, end quote. Throughout the Federal Reserve Bank publications, they call these bank liabilities money or checkbook money. We have learned that they are really tokens. The American Heritage Dictionary of the English language defines tokens as something you, quote, used as a substitute for currency, end quote. The bank substitute liability or token represents the real money, cash and promissory notes, recorded as a bank asset. An asset has value because you can sell it. A liability has no value by itself. Federal Reserve Bank of Chicago publication Public Debt Private Assets states that, quote, banks owe us the money that is in our account, end quote. Do not forget the borrower's transaction account that was created by depositing the promissory note. The next sentence claims the bank loans out our money earlier deposited. If we are the depositor, the bank owes us the money deposited. Then they loan us our own money. The bank owes us for the deposit which created a bank liability. The bank liability is the prima facie evidence that the bank owes us the money. The bank claims we owe them for the alleged bank loan. The bank liability owing us money cancels the liability we owe. Federal Reserve Bank publication Two Faces of Debt states that, quote, Federal Reserve notes are liabilities, end quote. And then explains how our currency is really unpaid bank IOUs. It is like you buying cars, houses, and boats simply by giving the seller an IOU and never paying the IOU. People then use your IOU like cash. The publication then claims that the bankers know that deposits are bankers' debts, IOUs. Any accountant will tell you a liability to the bank means you loaned the bank something for value, or the bank received something having actual cash value and deposited it. They know a new liability will also result if the bank stole your property, deposited it, and returned the value back to you as a loan. Certified public accountants universally know a liability is a debt owing money. The Fed publications clearly admit bank assets and liabilities, IOUs, both increase when banks grant loans. An IOU owing money is the opposite of money. The banker cannot discuss whether he loaned you money or the opposite of money. If he loaned you the opposite of money, you need to repay in the opposite of money. That is, a promise to pay money. The banks add money and the opposite of money together and call it money. This is like adding apples and a slip of paper called an IOU, owing you apples together and claiming the total is the number of apples you have in inventory today. Even a child knows an apple and an IOU owing an apple are not the same. Your child will choose an ice cream cone to eat, not an IOU owing an ice cream cone. The banker tried to sell you the IOU and never intended to give you the money. The bank IOU has no value and is worthless if it cannot be paid by a bank asset. The bank IOU is just like a casino token. If the bank can't get you to use the token as money, they can steal and counterfeit. If everyone must use the real money, cash or gold and silver coins, as money, giving everyone equal protection under the law, then stealing and counterfeiting will cease to exist. Interest and tokens are the banker's secret weapons, used in a silent war to seize your property and return it back to you as a loan. They keep the war silent, concealed, so they can quietly continue. They know if the voters learn the truth, the stealing and counterfeiting will end. It is your responsibility as an American to stop the bankers from denying us equal protection. The only way to stop a secret war is to expose it. We must inform all Americans so we can all join in saving the republic for which we stand. Chapter 20, Consideration. As judge and jury, you must decide if the bank gave consideration in accordance with the agreement, contract, and advertisement. The Dictionary of Banking Terms explains consideration as the lending of money in exchange for a borrower's promise to repay the loan. The key words are lending of money. Remember how the bank redefined money? Instead of calling gold or cash money, they redefined money to mean owing gold or owing cash. Typically, the lender loans you a check or some similar instrument. Remember how the bank redefined the word loan, calling it an exchange? By changing the definition of the word money to mean the opposite of money and changing the definition of the word loan to exchange, the meaning of the agreement has been completely altered. It now means the borrower funds the bank loan check. The Law Dictionary defines the following. Consideration: inducement to an agreement. The cause, motivation, price, cost, money, or impelling influence which motivates a contracting party to enter into an agreement. Contract: an agreement reached by mutual understanding which creates an obligation to do a particular thing. Each party must give up something of value. Competent parties, subject matter, legal consideration, mutuality of understanding, and mutuality of obligation, along with full disclosure of material facts, are essential for a valid contract. Did the agreement agree to an exchange, stealing, or a loan as consideration for the bank to obtain the promissory note? What was the legal consideration the bank loaned to obtain the promissory note? It was not the check because the promissory note funded the check. The contract or agreement is the highest law. Adequate considerations. I recommend you look up this in Black's Law Dictionary. If it shocks our sense of morality and of fairness, then it is not adequate consideration. The agreement called for a loan, not an exchange. The agreement was for the bank to loan you a check or similar instrument that is redeemable in cash. Did the bank give the borrower consideration in accordance with the agreement? The Federal Reserve Bank admits that the check is redeemable in cash and that you must repay the alleged loan. The Federal Reserve Bank also admits that the bank used the note signed by the borrower to fund the check. What was the money, cash, loaned as consideration to obtain the promissory note? No cash was loaned. The bank received an asset for free and never loaned an asset to obtain the promissory note. It appears to me that stealing the promissory note and returning the value of the stolen property as a loan is not moral and would shock the conscience of most Americans. As judge and jury, you must judge the following in accordance with the policies and procedures of the Federal Reserve Bank. 1. Did the bank give consideration in accordance to the alleged agreement? No. 2. Did the written agreement say loan or exchange? It said loan. 3. Did the bank loan legal tender or the opposite of legal tender? The opposite. 4. Did the bank loan the check back by cash as consideration loan to legally obtain the promissory note? No. 5. Did the bank obtain ownership of the promissory note without loaning 1 cent of legal tender or other depositors' money? Yes, but not legal ownership. 6. Did the bank significantly change the cost and the risk of the written agreement? Yes. 7. Is it true that the bank does not give up wealth to the borrower but instead receives wealth from the borrower? Yes. 8. Is it true that the bank check or checkbook money liability has no value without an asset called cash to give it value? Yes. 9. Did the cash come from the borrower's future labor, which has value today, and that the bank used to fund the check? Yes. What was the valuable consideration loaned if the bank received a promissory note for free? None.